Okay, hi, we're back. You know, I said multiple choice number 14. I meant 4. Kind of important getting the numbers right when you're an accountant. Anyway, we're going to do multiple choice number 4, which is basically how to calculate the price of the bonds. You have to take the present value of the principal and the present value of the interest. So through the magic here of our video technology, I have written up the answer for you, and we're going to take a look at multiple choice number 4 on page 362. So number 4 on page 362 says, what should be the issue price for each $1,000 bond? Now when they ask, they could ask for what is the issue price for all the bonds, or what is the issue price for just one of the bonds? And here they just want the issue price for one of the bonds. The following information pertains to Camp Corporation's issuance of bonds on July 1st of 2008. The face amount is $800,000. The term is 10 years. The stated interest rate is 6%. The stated interest rate is the contract rate, which is the rate that's printed on the bond certificate, and what they have contractually, what they're contractually required to pay the bondholders for interest. The interest payment dates happen every year, annually on July 1st, and the yield is 9%. Now I can already tell this is going to be a discount situation. You can tell this is going to be a discount situation because they're only going to pay the bondholders 6%, but the prevailing market rate, which is a yield, is 9%. So nobody's going to want that stinky bond that only pays 6% when the market's paying 9%. So definitely you're going to have to sell this bond at a discount. It's going to be a discount situation. And remember, you always use the market rate when you go to the present value tables. So here they give you a couple of choices for present value tables. They give you the 6% and they give you the 9%. The whole purpose of the 6% is to confuse you, that column. That's because the 6% is the contract rate. You don't care about the contract rate or the face rate, okay, or the stated rate, they say here, the rate which is printed on the bond certificate. You don't care about that. When you go to the present value tables, you want the market rate, and the market rate is 9%, and this does pay annually, so we don't have to divide by 2. And so then they give you present values, and they give you future values. You never use future value in financial accounting. I taught you that. In Module 11a, they will try and trick you with the future value. You do not use future value in financial accounting. You only use present value. Okay, so then you can scratch out that future value of 1 for 10 periods. That's just there to confuse you. You can scratch out the column that's 6%. You always want to use the market rate or the yield, which is the 9% column. So we have to calculate the present value of the principal and the present value of the interest payments. Now the principal makes only one payment one time, so you're going to use the present value of $1, and the principal amount is $1,000. It's $1,000 for one $1,000 bond because they want to know what should be the issue price for each $1,000 bond. So it's $1,000, and you're going to multiply it by the present value of 1 for 10 periods at 9%. You always use the market rate for the present value tables, and that's the present value for 10 periods at 9%. The present value of 1 is 0.422. I can do that math. It's $1,000 times 0.422, and you come up with $422. Then you take the present value of the interest payments, and the interest payments happen over and over and over again, and that's called an annuity. I have my, I prefer my calculator as opposed to the giant, large size. Oh my God, this face is bigger than my head anyway. This one. Anyway, so I have my own. So the annuity, the interest payments, and what you do is you take the contract rate or the stated rate that you promised to pay the bondholders. You promised to pay them 6% a year times $1,000, which is a face amount. That gives you an interest payment of $60 every year for the next 10 years. You multiply that by the present value of the ordinary annuity. Remember, this is an annuity because it's a stream of equal payments. The $60 happen every year for the next 10 years. Multiply that by the present value of the ordinary annuity for 10 periods at the market rate of 9%. That's 6.418. There it is under the 9% column. And multiply that by 60, and that gives you 385. You add them together, you get 807. You can see then that's a really, really big discount from the $1,000, and that's because your bond is only paying 6%, and the market's paying 9%, so that's the only way you can get anybody to buy it is if you buy it, sell it for cheaper, so you sell it at a discount. So the correct answer then would be 807. You have to add up these two present values. The correct answer then for number 4 would be C. Let's take a look at multiple choice number 6. Number 6 on the same page. The best answer for number 4 is C, 807. Number 6 says, the market price of a bond at a discount. Looking at number 6, the market price of the bond issued at a discount. Hey, did we just issue a bond at a discount? We sure did. Is the present value of the principal amount, there's the present value of the principal amount, at the market or effective rate of interest. Remember, when we went to the present value table, we always look at the market interest rate column. Is it A, less than the present value? No, we added these things together, didn't we? We added them together, right? So it's not less than. It's not less than A and B, so it's plus. Now let's take a look at answer C. Answer C says, plus the present value of the future interest payments at the market rate of interest. That is the correct answer. It's the present value of all the interest payments we're going to receive using the market rate of interest. Remember, we went to the 9% column. So the correct answer would be answer C. Why is answer D wrong? Answer D is wrong because it says plus the present value of all the future interest payments at the rate of interest stated on the bond. You don't take the present value using the stated rate. You take the present value using the market rate. So remember, we chose the market rate and multiple choice number 4, which is the 9% column. So that's why answer D is wrong, because it says you go and you take the present value using the stated rate, and that's not right. So the best answer for number 6 is C. Okay, let's go back to our notes. Okay, let's take a look on page 357. On page 357, right in the dead center of the page, under item number 4, item number 4 says the journal entries, and we had already looked at the journal entries for issuing a bond at a premium. We had talked about that. If you look at underneath the journal entries 4A, B, and C, they say entry A. It's right in the dead center of the page. I'm on page 357 in the middle of the page. It says entry A assumes that the bonds are issued on the interest payment date. If bonds are purchased between interest payment dates, the purchaser will include accrued interest through the purchase date in the total cash paid for the bonds. Okay, what does that mean? Well, as I told you, remember we accumulate all of these bond issue costs because it's a lot of work to get bonds ready. You have to pay accountants, you have to pay lawyers, you got to pay the SEC, you got to register them, you got to print up the prospectus, print up the bond certificates. Okay, you print them all up, you accumulate all those costs in the T account called the bond issue cost, which is a debit balance, which is a deferred charge that you keep as other asset on your classified balance sheet. The thing is that you do all this work to get ready to issue the bonds. You say, we're going to issue the bonds on, say, April 1st. And then suddenly April 1st is just a bad day to issue bonds. Something happens in the world, and there's something going on in the world all the time. And sometimes the things are just bad things. And that something bad happens, and then you decide this is just really not a day to issue bonds this day. Perhaps the Federal Reserve chairman, I don't know, he doesn't do something right with the interest rates, and then the market just goes crazy, and the bond market goes crazy. Okay, so it's just not a good day to issue bonds that day. So you wait a little bit till the market comes down, and then you issue your bonds. The thing is that when you print up when you print up the bond certificate, you always put a certain due date on there because your bondholders have to know when they get the certificate when the bond is going to be due. And then you write the computer program so that it spits out bond payments periodically. So if you don't sell the bonds on that particular day, the software is already written and the bond certificate's already printed up. So what happens is that when you eventually do sell the bonds, the bondholders are going to have to pay for the time period between the date that's printed on the bond to the date they actually buy it. And they're going to have to prepay certain amounts of interest. So if you issue a bond on it's dated April 1st, just like we had the example of the bond issue cost, and you don't issue the bonds until August 31st, they're going to have to pay for accrued interest from the period from April 1st to August 31st. Do you remember how we did that one? We took a look at multiple choice question number 9. If you go back to page 362, multiple choice number 9. Remember in multiple choice number 9 on page 362, the bonds were dated April 1st, but we didn't issue them until August 31st, and 5 months ticked by, and you're only allowed to amortize the bonds over the life, which means it shortened it by 5 months. Well, it's the same thing. If they go ahead and buy the bonds on August the 31st, they're going to have to prepay the interest payment from April 1st to August 31st, because later on when they get an interest payment, they're going to get an interest payment for the full amount. All right, so they have to prepay the months they did not have the bonds. Let's take a look at a multiple choice question like that. Multiple choice question number 7 works exactly that way. Multiple choice number 7 is found on page 362, and number 7 on page 362 says, what amount did Eagle receive from the bond issuance? Okay. Number 7 says, on July the 1st, 2008, the Eagle Corporation issued 600 of its 10%, $1,000 bonds at 99 plus accrued interest. The bonds are dated April 1st, and they mature on April 1st, 2018. Interest is payable semi-annually on April the 1st and October 1st. What amount did Eagle receive from the bond issuance? Well, see, this is a perfect example of that. When you printed up the bond certificates, you said, well, I'm going to issue these on April the 1st of 2008. Well, April the 1st, 2008 came, and it was not a good day to issue bonds. And you had to wait for the market to slow down or something to happen with the market. And then it became a much more favorable time to issue the bonds on July 1st. The thing is, the bonds say they mature 10 years from April 1st, 2008. They mature on April 1st, 2018. And you already have the prospectus of the bonds and the bond indenture, which is a contract you have with the bondholders. No matter what, you're going to have to pay the bondholders their first interest payment on October the 1st. Well, that's not fair. If the bondholders buy the bonds on July 1st, that they then get a 6-month interest payment on October the 1st because the computer program has been programmed to spit out 6-month interest payments every 6 months. They're going to pay out 6 months payments, all right? So what happens is that the bondholders have to prepay 3 months of interest for the period they did not hold the bond, which is from April 1st to July 1st, which is 3 months, April, May, and June, okay? That way, when they prepay 3 months, when they get the interest payment on October 1st, which is for 6 months, it nets out 3 months prepaid minus the 6 months they get, which is the 3 months that they are entitled to for July, August, and September. They'll get that payment on October 1st. So let's see what we can do with this. The best way to do this is always to do a journal entry. Folks, you can never go wrong with doing a journal entry. You can never go wrong with doing a T account. You can never go wrong with relating the journal entry to how it would appear in the financial statements. You could never go wrong by relating to how these disclosures will appear in the financial statements, because that's what financial accounting is all about. So they want to know, what amount did Eagle receive from the bond issuance? Well, they can also say when they issue the bonds, they issued them at 99. That means they issued them at a discount, which means 99% of their face value. If they issued them at 102 or 102, that means they issued them at 102% of their face value, which means there's a 2% premium. Here they issued them at 99, which means there was a 1% discount, because 100% minus 99% is 1%. Okay. Always start off with bonds payable. Credit bonds payable at the face amount. The face amount of the bonds in number 7 is 600 of its $1,000 bonds. I can do that math. That's $600,000. So you're going to credit bonds payable at $600,000, which is the 600 bonds times $1,000 a piece. Then you know that they issued them at 99, which means there's going to be a 1% discount. 1% of the $600,000 is going to be $6,000. So you're going to have a discount on bonds payable. Discount on bonds payable is a contra liability account. It's a normal balance of debit, because liabilities have a normal balance of credit. Contra liability has a normal balance of debit. So this is the 1%, because 100% minus 99 is a 1%, so that's a $6,000. Now, what you're going to do is you're going to credit the interest payable. The interest payable is going to be for the period which occurred from April 1 through July 1, okay? And that's going to be 3 months. So you take 3 months over 12 months, okay? You multiply that by the contract rate of interest. The contract rate of interest here is 10%. And you multiply that by the face amount of the bonds, which is $600,000. And remember this, they have to prepay, the bondholders have to prepay for the time period they did not hold the bonds. Because in the end, on October 1st, they're going to get an interest payment for the full 6 months. So you take 3 months over 12 months, times the 10%. Well, 10% times 600,000 is 60,000. 3/12 is about 1/4 of the 60,000, so that's going to be 15,000. So then your interest payable is going to be credited 15,000, and then you'll debit cash, which is a plug for the amount of the proceeds. So 600 plus 15 is 615 minus 6, which is going to be cash of 609,000. So you're going to debit the 609,000. So they want to know In item number 7, multiple choice number 7 on page 362, what amount did Eagle receive from the bond issuance? They will receive $609,000. By the way, what is the carrying value of the bond? The carrying value of the bond, the way you report the bond is going to be like this. You always have the bond at bonds payable at its face amount, which is $600,000, minus the discount, which is $6,000, gives you the bonds payable at its carrying value or book value of $594,000. So they could easily have asked you, well, what is amount of your what is the carrying value of the bonds? The carrying value of the bonds is $594. That's not what they asked. They asked, what is the amount of the cash proceeds that you received, which is $609,000. So that's why the answer there would be D, like David. But had they asked for, what is the carrying value of the bonds? The carrying value of the bonds would have been $594. So that answer would be answer B, like Barbara. Now, let me tell you something. This, and it's the 600 minus the 6 is a 594. This interest payable of $15,000, this interest payable of $15,000 is completely different from this bonds payable carrying value of $594,000. The reason that they're different is this is a long-term liability. This is a long-term liability. After all, this thing is not going to be due let's see, issued 600 of its bond. Well, it's a long term. It doesn't. It's due in 2018. So it's due in 10 years. Okay, this is a long-term liability. Folks, this right here, this is a current liability. When are you going to have to pay this? You're going to have to pay this on October 1st of 2008. Okay, so this is a current liability. This right here is a long-term liability. And never the two shall meet. So don't try and take them and do this. Don't try and net them together. Don't do that. Long-term liability, current liability. Okay, so I want you to know that. So they go in two completely different parts in the classified balance sheet, long-term liability and current liability. So keep that in mind, because they could also ask you, what is the total amount of the current liability? The total amount of the current liability is $15,000. The total amount of the long-term liability is $594. Okay, all right. But since they asked for the proceeds for multiple choice number 7, the answer is D. Oh, there's one that's really, it's just such a sick problem. All right, there's one that's really, really, really bad. Which one? It's just very, very tricky. It's when they ask for what are the proceeds. Oh, yeah. Multiple choice number 5. Oh, this one's just so bad. But, I just can't show you the easy ones, all right? I have to show you all the hard ones, okay? Now, notice that in number 7 said they want you to know what are the proceeds, and the total proceeds, these are the total proceeds, which is $609,000. You see, you have to kind of read into these questions. There's a difference between the proceeds, which is like the gross proceeds, and there's a difference between that and then the net proceeds. The net proceeds is net, after you've paid out everything that you need to pay out. For example, take a look at multiple choice number 5. Number 5, which is also found on page 362, says, number 5 says, the PERC company issues $500,000, 10% bonds to yield 8%. So it's 10% bonds. That's the contract rate. They yield 8%. The market rate is 8%. Okay, I can already tell you that this is a premium situation. How do I know it's a premium situation? We promised to pay the bondholders 10%, but the market rate is only 8%. So everybody wants our bonds, so we're going to sell them at a premium. The bond issuance costs were $10,000. Okay, remember the bond issuance costs, those are your deferred charge. They show up as an other asset on your classified balance sheet, and then you amortize them over the life of the bonds. Remember, we did that on multiple choice number 9. Then they say, how should PERC calculate now look what they say. They don't say proceeds. They say net proceeds. This is why it's so important to read the stem of the question carefully. They say, how should PERC calculate the net proceeds to be received from the issuance? And then they have the letter A, B, C, D. They say discount, 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 discount. They start every single answer with discount, discount, discount. And you're probably saying, well, what do you mean discount? This bond was issued at a premium. Well, yeah, but the way they're using the verb to discount something means to take the present value of. So if you substitute the word discount for to take the present value of, that's really what they're talking about here. Letter A says, instead of discount, say, take the present value of the bonds at the stated rate of interest. No, when you take the present value of the bonds, you always use the market or the effective rate of interest. Letter B says, take the present value of the bonds at the market rate of interest. That's true. if you're calculating the proceeds. But what they want is they want the net proceeds, which is after you subtract all the other things you have to pay for. Letter C says, take the present value of the bonds at the stated rate of interest and deduct the bond issuance cost. Well, that's wrong because you take the present value of the bonds using the market rate, not the stated rate. Then they have letter D. Take the present value of the bonds at the market rate of interest and deduct the bond issuance cost. And that's the correct answer. The correct answer is D, like David. Because in the stem of the question, they said, how should PERC calculate the net proceeds? Now, if they had asked for how do they calculate just the proceeds, which is the gross proceeds of the bond, the proceeds of the bond would have been answer B, like Barbara. But the fact that they asked for the net proceeds means you have to subtract all the bond issuance costs. So the best answer for that would be answer D, like David. Oh, that's just so tricky. But remember, I'm going to show you. Always look for the difference. Are they asking for the gross proceeds or are they asking for the net proceeds? When they say net proceeds, they will say net proceeds if they want that. Okay? If it's proceeds, just assume it's the gross proceeds. Okay. Now we can do a multiple choice question on an amortization schedule. Let's take a look at multiple choice question number 14, please. Number 14. Number 14 is found on page 363. And in number 14, we're going to do an amortization schedule to solve this. Number 14 says, in its June 30th of 2008 balance sheet, what amount should West report as bonds payables? They want to know what do you report as the bonds payable for number 14 as of June 30th of 2008. Number 14 says, on January 2nd of 2008, the West Company issued 9% bonds in the amount of $500,000, which matures in January 2nd, 2018. The bonds were issued for $469,500 to yield 10%. Interest is payable annually on December 31st. West uses the interest method of amortizing bond discount and does not elect the fair value option for reporting financial liabilities. Now, they're telling you to use the effective interest method, which is the method that you would always use in the exam. There's actually two methods of amortizing the interest. The two methods are the straight line method and the effective interest method. You must use the effective interest method whenever interest is material. You can only use the straight line method of amortizing interest when the interest is immaterial for GAAP purposes, okay? And so don't use straight line until they actually tell you to, all right? You're going to assume to use the effective interest method whenever they say amortize. So they say they use the interest method of amortizing bond discount, so that's the effective interest method, instead of the straight line method. Remember, do not use straight line until they tell you to, because you can only use straight line method if the interest is immaterial. And they do not elect the fair value option for reporting financial liabilities. And it's June 30th, 2008 balance sheet. What amount should West report as the bonds payable? Now, even though these bonds, they were issued on January 2nd, 2008, and they pay interest every December 31st, and they're annual bonds. Notice where they cut off. They say in its June 30th, 2008 balance sheet, what amount should West report as bonds payable? So you only can accrue one half of this. So you have to effectively make this from an annual bond into a semi-annual bond because you can only accrue 6 months worth of the interest. So how would you do your amortization schedule? Just like you did the amortization schedule, which we just went over for the premium situation, which was in your textbook. Remember, for the 10,514? You're going to have an amortization schedule that looks like this. You're going to have some sort of a period or date format. You're going to have some sort of an interest payment. Then you're going to have your interest expense. Then you're going to have some sort of a plug figure, which is really going to be the amortization. Then you're going to have the carrying value. I prefer to call it the carrying value. Your book calls it the book value. The period always starts with 0. Everything is always going to be blank except for the initial carrying value, which you calculate as the present value of the interest plus the present value of the principal payment. Here they give it to you. They said they issued the 9% bonds in the amount of $500,000, which I'm doing number 14 on page 363. It matures on January 2nd, 2018. The bonds were issued for $469,500 to yield 10%. So you put here $469,500. Now remember, this happened when? This happened on January 2nd, 2008. January 2nd of 08. Now, you're going to have to accrue this as of June 30th of 08. So even if it's an annual bond, you're going to have to make it semi-annual because this is only 6 months from this date. Okay. So the interest payment, They have a contract rate here. They issued 9% bonds, but since we're only talking about 6 months, that would be 4.5%. So this would be calculated as 4.5% times the face amount of the bond, and the face amount of the bond is going to be $500,000. So you take 4.5%, 0.045 times $500,000, and that's going to give you $22,500. So the interest payment then is going to be $22,500 that you're going to have to accrue on June the 30th. The interest expense is going to be the market rate times the carrying value. And the market rate here, they said that the yield, to yield 10%, remember yield to maturity, effective rate, market rate, also the real rate, these all mean the same thing, which is the predominant rate in the market on the day that you should issue the bonds. They say it's 10%, but since we're only taking it for 6 months, that would be 5%. So this is 5% times the carrying value. So the 5% times the carrying value of the $469,500 is going to give you $23,475. $23,475. Then you just take the difference between the $22,500 and the $23,475. That's going to give you $975. What do you do with this $975? Well, the carrying value always has to approach what is owed. What do you owe on this bond? You owe $500,000 when it matures. Okay. You owe $500,000 when the bond matures. All right. Now, this bond was obviously sold at a discount. Why was the bond sold at a discount? The reason it was sold at a discount is because our coupon rate, or stated rate, what we promised to pay the bondholders, is only 9%. The market is demanding 10%. Nobody's going to buy this bond unless we sell it at a discount because we're only paying 9 and the market's paying 10. So it has to approach this $469,500, has to approach the $500,000. To that, you'll take the $469,500 plus the $975. The correct answer would be $475. Let's just amortize one more time to get the hang of this. Okay. Then we'll do another 6 months. Would be 12/31/08. This is going to be exactly the same, right? The $22,500. Then the interest expense, once again, is going to be 5% times the $475 times the 5% is going to give me about $23,524. About that. $23,524 minus the $22,500 is $1,024. The $1,024 I'm going to add to this. 1,024 plus the 475 equals 499. Okay. Now, what's happening here is they want to know, in its June 30th, 2008 balance sheet, what amount should West report as the bonds payable. This is the amount that they're going to report as the bonds payable, which is a $475. How would they report this? It would be the bonds payable at the face amount, which is $500,000, minus the ending balance in the discount account, will give you the bonds payable at its carrying value, which is the $475. Now, what is the ending balance in the unamortized discount? Well, it's just going to be the mathematical difference between these two. 500,000 minus a 475 is going to give me 29,525. Now, let me tell you what they could ask. For any period, they could ask. Number one, what is the amount of the interest expense? The amount of the interest expense is going to be $23,475. Number two, what is the ending balance in unamortized discount? The ending balance in unamortized discount at June 30th, 2008 is $29,525. Number three, what is the carrying value of the bond? At June 30th, 2008, the carrying value of the bond is going to be $475, which is the face amount of the bond of $500,000 minus the ending balance and discount on bonds payable of $29,525 gives you the bonds payable, its carrying value of $475. So let's answer its question. In its June 30th, 2008 balance sheet, what amount should West report as bonds payable? The correct answer is $475. So the correct answer is B, like Barbara. Folks, this is a long-term liability. Now here, on June 30th, what I'm going to do is I'm going to accrue this interest payment, because the interest payment is not due until December 31st. So the journal entry that I would make is I would debit the interest expense for $23,475. I would credit interest payable for the $22,500. And then the difference would be the amortization of the discount. Remember, discount on bonds payable is a contra liability account. Has a normal balance of what? Debit, because it's contra liability. To amortize it, I would have to credit it. All right? So I'm crediting the discount for the $975 here. Because the $22,500 plus the $975 is going to give me the $23,475. Okay, so that's what's going on with the journal entry. Now, on December 31st, what you would do is you would accrue the interest expense, you'd amortize the discount, okay, and then you'd debit the interest payable for 2 times this amount, because you would owe both 6 months worth, the $22,500 and for this 6-month period here, and another $22,500 for the next 6-month period here, okay? And you'd pay the full 12 months, but you don't have to do that until December 31st. Here I was just accruing it for June 30th, 2008 for the balance sheet date. Okay, so once again, what are the 3 questions? Hey, folks, we do these same dumb 3 questions over and over again. Remember bad debt expense? Number 1, what is the bad debt expense? Number 2, what is the ending balance and the allowance for doubtful accounts? Number 3, how do you report accounts receivable on the balance sheet? You report accounts receivable and accounts receivable net. When we did, or the net realizable value. When we did depreciation expense, the same 3 dumb questions. Number 1, what is the amount of depreciation expense? Number 2, what is the ending balance in the accumulated depreciation account? Number 3, what is the carrying value of the asset? Or how do you report the asset on the balance sheet at its carrying value or book value? That is property, plant, and equipment at a historical cost minus the ending balance in the accumulated depreciation to give you property, plant, and equipment net. It's the same questions over here. Number 1, what is the amount of the interest expense? Number 2, what is the ending balance in the discount on bonds payable, which is a contra liability account. Number 3, how to report the bonds on your balance sheet. You report it at the carrying value, which is the face amount minus the ending balance in the discount account to give you the bonds payable at their carrying value. If this was a premium, it would have been bonds payable at the face amount plus the premium to give you bonds payable at the carrying value. That's all they can ask. And then, where do you report these things? Interest expense. Where do you report the interest expense? On the multiple step income statement on page 128 of your textbook. It gets reported in minus other expenses and losses. If you go back to page 128 where the multiple step income statement is, it's minus other expenses and losses. Where do you report the carrying value of the bonds payable? In the long-term liabilities. Where would you report the interest payable for 22.5? Report this in the current liabilities. And remember, never the two shall meet. Current liabilities is different from long-term liabilities. They're in 2 different places. All right. Let's see what else we can answer here. Let's take a look at multiple choice number 16. Now, this one is kind of a tricky one. Before I answer number 16, let's just review what's going on with the amortization schedule. On the bottom, page 357, if you look on the bottom page 357, remember we had an amortization schedule for a premium situation. In the amortization schedule for a premium situation, if you look, you start off at the $10,514, and you make your way steadily. I'm looking at the very bottom, page 357. If you look at the carrying value, which is the far right-hand column, you start at $10,514, and you make your way steadily towards $10,000, because the carrying value always approaches what is owed, okay, at the end when the bond matures. But remember, we get there at an increasing rate. It decreases, but at an increasing rate, because it goes from $10,514 down to $10,476. That's a difference of $37. See the plug figure? That's a decrease in the book value. Then it goes from $10,476 to $10,438. That's a difference of $38. So what's happening is that it's decreasing, but it's decreasing more and more and more quickly. So that if I were to graph something like that, here we go. And I'm sorry, I am a terrible artist. So here's the 10,514, and we need to get down to the 10,000. So what happens is that you're going down, but faster and faster and faster. So what happens is it kind of looks like this. You see that? It goes down faster and faster and faster. Now, what we just did is when we amortize our discount, if you take a look at our discount situation, which I had over here, what happens is this goes from $469,500 to $470. It's going up because we start off then. Let me just put that right here. This was a premium situation, And this is sort of like dollars, and this is sort of like time, and then this is zero, right? And then over here, we're going to have a discount situation. And we have dollars here, and this is zero, and then this is time, like the number of periods. And we start off in what we just did for this multiple choice problem. We start off at 469,500, and we need to get to 500,000. So let me just put, this is 500,000 here, and then this is the 469,500. So what happens if you look here, we start off at the 469.5, and we go up by 975 to 470. And then we go up from 470 to 471, we go up by 1,000. So what happens is we're increasing, and every time we increase, we're increasing at an increasing rate. Here we're decreasing at an increasing rate. So what happens is that, the way this looks is it'll look kind of like something like this. Okay, I'm a terrible artist. It's supposed to be like a little scoop. You try and make it better. It's just like such a terrible artist. It kind of like looks like that. It's like a little scoop. Okay. And then this is like a little hill going downhill. All right. So remember, you're increasing at an increasing rate here, from here to here, from here to here. You're increasing at an increasing rate because first you went up by 975, then you went up by 1024. And then at the bottom of page 357, you're increasing, you're decreasing at a decreasing rate. First you went down at the bottom of page 357 in the amortization schedule. First you went down $37, then 38, then 39, then 40. So you're going down faster and faster. Okay, let's see if we can answer the question here. And the reason is because no matter what, the amount that you're amortizing is increasing more and more and more. That plug figure, if you look on page 357 in the column that says decrease in book value, which I told you was a plug, which is the amortization of the premium, the amount that you're amortizing for the premium is increasing. Not only here, the amount that you're amortizing for the discount, the amount that you're amortizing for the discount is also increasing. So let's take a look at multiple choice number 16. Number 16 says, for the issuer of a 10-year term bond, the amount of the amortization using the interest method, that's the effective interest method, would increase each year if the bond was sold at a discount, was sold at a premium. The answer is yes and yes. No matter what, the amount that you amortize in a discount situation, the amount you amortize is increasing. Went from 975 to 1,000 here. At the bottom of page 357, when you look at the decrease in book value, the amount that you're amortized for the premium, that is increasing each period. So the answer is the amount increasing each year if the bond is sold at a discount? Yes. If the bond is sold at a premium? Yes. The answer is yes and yes. So the correct answer for number 16 is B, like Barbara. Folks, there is no way to understand that and do that correctly until you do an amortization schedule and you understand how the amortization schedule works. Okay. Now, let's take a look at an even more difficult one. Now, that one was hard, but they get even worse. Let's take a look at multiple choice number 17. Now, remember, if the questions get harder on the exam, that's a good sign. It means you did well. Because if Testlet 2 seems harder than Testlet number 1, you did really well in Testlet number 1, okay? Because the exam, it adjusts, The better you do, the harder the questions get. And, I show you some really hard questions. Number 14, what made number 14 tricky, it says it was annual, but you had to make sure to adjust it to semi-annual because from January 2nd to June 30th with only 6 months. The number 16 made it difficult because you really had to understand how the numbers work in an amortization schedule. Number 17 is even harder because in number 17 what they're doing is they're asking you to compare and contrast the straight line method versus the effective interest method. Now, let's just say the straight line method goes from the 10,514 to 10,000. It does it exactly the way it sounds, in a straight line. And a straight line would kind of look like this. Well, I tried to make it as straight as I could, okay? All right. By the time they mature, they meet up at the same place. Okay. Now, for here, for a discount situation, it goes, up, and it goes in sort of like a straight line. Okay. By the time they mature, where they all meet, they mature at the 500,000. Here, they mature at the 10,000. Okay. That's what the face amount is. So they end up in the same place. It's just how they get there. So it's a straight line method. It looks like a straight line. Well, I tried to make it as straight as I can. Number 17 on page 363 says, NAS does not elect the fair value option for reporting financial liabilities. That means they're doing it the ordinary, old-fashioned way, which is what we're doing. How's the carrying amount of the bonds affected by this error? On January 2nd of 2008, the NAS company issued 8% bonds with a face amount of $1 million that matures on January 2nd, 2014. The bonds were issued to yield 12%, resulting in a discount of $150,000. Now, this is a discount situation because we're only paying 8% to the bondholders, but the market is paying 12%. So you can see that the bondholders are not going to take that stinky 8% when they get 12% unless we sell them to them really cheap. So they were sold at a discount. NAST incorrectly used a straight line method instead of the effective interest method to amortize the discount. Now, the straight line method basically means that you take the difference between the $469,500 and the $500,000. You take that difference and you just divide it by the number of periods, and everything, you just straight line it, okay? That's not what we do here. We saw that the interest expense was changing, and the amount of the discount here that we were changing was different every time. Remember, you're only allowed to use a straight line method if interest is immaterial. I'm going to tell you, on the exam, you're going to have to use the effective interest method because interest is always going to be material on the exam. And if they're silent towards what to use, always use the effective interest method. Do not use a straight line method until they tell you. Here they're saying you incorrectly use a straight line method in this discount situation. NAS does not elect the fair value option for reporting financial liabilities. How is the carrying amount of the bonds affected by this error? Well, first of all, by January 2nd, 2014, there's not going to be any effect. There's no difference because no matter what, when they finally mature on January 2nd, 2014, they both have to end up at the same place, which is the face amount, which is $1 million. So what did this do, though, at the end of the first year? Well, if you look at the end of the first year, remember that this is a discount situation. This is the discount situation. They incorrectly used the straight line method when they should have used the effective interest method. So you can see the straight line method. Let's just say period 1 would be sort of here. You can see that the straight line method is above the effective interest method in terms of their carrying value. You see that? So we would say then that the carrying value would be overstated if you had used the straight line method. Okay? So let's answer the question. How is the carrying amount of the bonds affected by this error? At the end of the first period, which is December 31st, 2008, the straight line method is above the effective interest method, so we would say that it's overstated, the carrying value is overstated, and that by the time that they mature all the way here, when they finally meet at the face amount, that there is no effect. So the correct answer then would be overstated and no effect. The correct answer then would be B, like Barbara. What if this had been a premium situation? If this had been a premium situation, here's a premium situation. Let's see, this would be at about the first period. It would be right here. You could see that if they had used a straight line method instead of the effective interest method, then it would be the opposite. It would have been understated, in which case it would have been understated and no effect. The answer would be D, like David, for a premium situation. But since it's a discount situation, the answer is B, like Barbara. Folks, this is the way you have to do these questions. You have to think, this is the answer for a discount situation. This is the answer for a premium situation. Okay? That's the way you have to do the questions. All right. All right. Let's let's see what else we can work on. Okay. I think what I want to do next is I just want to take a look now. We're going to do a little switcheroony. And in the same chapter, they talk about bonds as liabilities. You have to also talk about bonds as investments. That's right. Now, remember, when you borrow money, you have a bonds payable, but they have to sell that bond to someone. And the person who buys the bond has an investment in bonds. Okay, so now we're going to do a little switch and think about the bonds as being an asset, as an investment. So I'm going to erase this for a minute now. And I just want to review with you a little bit. Now this is, assuming standard number 115. This is not assume standard number 159, which is a fair value option. That's something different. This is the old-fashioned way of doing things. Okay, bonds as investments now. Now we're doing a switcheroo. We're now leaving bonds as liabilities. We're now talking about bonds as assets. Bonds as investments. Okay. Well, when you invest in investments, okay. When you invest in the bonds, you can hold them into 3 categories. The 3 categories are trading, available for sale, and held to maturity. So this is all under standard number 115. Once again, the 3 categories, when you invest in bonds, you can have them in 3 categories. They are trading, available for sale, and held to maturity. Okay, under standard number 115, they have something called mark to market, which, by the way, has been in the news a little bit lately. They're blaming that accounting rule for the collapse of the financial services industry. Anyway. Mark to market. Okay. So that means, do you have to carry it at fair market value on your balance sheet? All right. If it's a trading category, now let me tell you the difference between these, okay? Held to maturity means you're going to hold it until when? Until you mature, okay? Until it matures, and that's how long you're going to hold it. Available for sale, let me talk about trading. Trading means in the short term. Trading means that you're really holding it for speculative purposes. You're buying it low so you can sell it high. And the definition of available for sale is neither trading nor held to maturity. That's the definition. So held to maturity is you're going to hold the bond until it matures. Trading means you're going to hold it in the short term. It's a current asset. And you're holding it for speculative purposes. You're going to buy low and sell high. And available for sale is neither trading nor held to maturity. Typically, why you buy something for available for sale is you have a lot of cash sitting around. You don't want it to be idle. You want to generate some interest revenue from it. So you take your cash and you invest it in a bond that's sort of like a safe investment so you can generate interest, and then when you need the cash to, say, make payroll or buy a piece of equipment, you need the cash right away, then you can just sell the bond and then get the money. But in the meantime, you're earning interest, so it's available to sale for you. But the technical definition of available for sale is neither trading nor held to maturity. For mark to market, you are supposed to put it on if it's trading category, you put it on the balance sheet at fair market value. So balance sheet at fair market value. If it's available for sale, you are supposed to put it on your balance sheet at fair market value. If it's held to maturity, it's supposed to go on there at carrying value. Carrying value. So there is no mark to market, okay? Because fair market value is irrelevant because you never intend to sell it, okay? Because you're going to hold it until it matures. Now, this is under standard number 115, okay? Now, because you're valuing this on your balance sheet at fair market value, you might have an unrealized holding gain or loss, in which case the unrealized holding gain or loss goes to the income statement, and it goes to income from continuing operations, which I taught you was, remember income, remember in module 7D, we had the income statement, income from continuing operations, D stands for discontinued operations, E stands for extraordinary gains and losses. The unrealized gain or loss from marking it up or marking it down, because it goes up in value, goes down in value, when you mark to market, to fair market value for trading securities goes to income from continuing operations. So it goes on the income statement. For available for sale, the unrealized gain or loss goes to other comprehensive income. This is a separate component of shareholders' equity. Other comprehensive income is a temporary account that gets closed into accumulated other comprehensive income. I taught you this in Module 7D when we talked about the definition of comprehensive income, which consists of net income plus other comprehensive income, and this is one of the other comprehensive income items. Here, though there is for held to maturity, there is no unrealized holding gain or loss. The reason is because you put it on carrying value on your balance sheet. The carrying value comes from the amortization schedule. You do the exact same amortization schedule that you use for the bonds payable. It's the same exact amortization schedule here. Now, for available for sale, you do also have to do an amortization schedule. So let me just put that over here. Do you have to do an amortization schedule? So amortization schedule. For trading, the answer is no. Amortization schedule. For available for sale, the answer is yes. For held to maturity, it's yes. So the carrying value from the amortization schedule just goes on your balance sheet, and that's what the carrying value you put here on your balance sheet. Now, what about available for sale? Do you have to do an amortization schedule? Under standard number 115, as long as you do not elect the fair value option, yes, you have to do an amortization schedule. Then, the carrying value from the amortization schedule versus the fair market value, that difference is the amount that becomes the unrealized holding gain or loss, which then goes into your other comprehensive income. Okay, that goes into your other comprehensive income. So what does that mean? Let's just go back to page 357. If you take a look on page 357, and at the bottom of page 357, remember we have our amortization schedule for our bond that we issued at a premium. Let's just say that I'm an investor and I buy all the bonds. If I buy all of these bonds, I can hold these bonds in one of three categories. They are trading, available for sale, and held to maturity. So go back to page 357, look at the amortization schedule there. Let's just assume that I buy these bonds as trading. Okay? If I buy these bonds as trading, I bought them for $10,514. Let's just say that at the end of the first period, they're worth $10,600. Because I bought them at $10,514, I do not have to do an amortization schedule, so they are at the $10,514. At the fair market value is $10,600. What I would do is take the difference, which is, Cindy cannot even add this up in her head, 10,600 minus 10,514. That would give me a difference of 86, and that would be an unrealized holding gain because it's trading, and that would go into income from continuing operation. It would go into plus other revenues and gains. Now, let's just assume that was for trading. Let's just assume then that I had this as a category available for sale. If this was a category of available for sale, am I supposed to do for available for sale? Am I supposed to do an amortization schedule? The answer is yes. Then what would happen is I would take the fair market value of $10,600 and I would compare that with the amortization schedule. Let's just take the first period amortization, which is the carrying value after the first period amortization is $10,477. So $10,477. Well, it's really $10,476.85, but I don't care about pennies. Give me the 15 cents. So then I would take the carrying value from the amortization schedule, compare that with the fair market value as the balance sheet date, and take the difference. So then that would be $10,600 minus the $10,477, which is $123. And where would this unrealized gain go? This unrealized gain would go into other comprehensive income as long as I'm following standard number 115 and I do not elect the fair value option. So I would put it on my balance sheet at $10,600. The $123 unrealized holding gain goes to other comprehensive income. Okay. Now, what happens if I had to do then this bond, but I selected that I was going to have this bond at held to maturity? Do I have to do an amortization schedule? The answer is yes, I have to do an amortization schedule. How do I put it? Do I mark to market? No, I'm supposed to put it at carrying value in my balance sheet. There is no mark to market. Okay, there is no mark to market. In which case, at the end of the first period, I would carry this at $10,477 on my balance sheet. So, trading, $10,600, $86 unrealized gain that goes to the income statement and plus other revenues and gains. Available for sale, put on your balance sheet $10,600, unrealized gain of $123 that goes to other comprehensive income, a separate component of shareholders' equity. Held to maturity, I value this at $10,477 on my balance sheet. There is no unrealized gain or loss because you do not mark to market because fair market values are relevant when you plan to hold it to maturity. Now, what happens if you elect standard number 159? If you elect standard number 159, which is a fair value option, all those rules get thrown out the door. Everything gets put on the balance sheet at fair market value, and you mark from fair market value. So no matter what, it doesn't matter if it's trading, available for sale, held to maturity. It's $10,514 is what you originally purchased. You compare the $10,514 versus the $10,600, which is the difference of, oh, my pen is dying. $10,514, which is what you purchased it at, which is a difference of 86. And this 86, unrealized holding gain or loss, under standard number 159, as long as you elect the fair value option, doesn't matter if it's trading, available for sale, or held to maturity, any one of those categories, you can elect the fair value option. You put on your balance sheet at $10,600, which is the fair market value, and the difference between what you purchased it at, which is $10,514, and the $10,600, that $86, that all goes to income from continuing operations, which is plus other revenues and gains, and this value goes on your balance sheet. No amortization schedules have to be done. That's under standard number 159. Okay. So you always have to think, is it the old standard where I don't elect fair value, or is it the new standard where I elect fair value? And who can you thank for this? You can thank the International Accounting Standards Board, because the only reason why they threw in standard number 159 is to make U.S. standards more like the international standards. And darn it, they just made life harder for us. Okay? Let's just take a look at some multiple choice questions. These have to do now with bonds as investments. We're going to take a look at multiple choice number 22 and number 23. Number 22 and number 23 are found on page 364. Number 22 and number 23 are found on page 364. And remember, we're talking about bonds as assets. Number 22 on page 364 says, in its December 31st, 2008 balance sheet, what amount should WIN report for short-term investments in trading debt securities? Okay, so it's trading. On July 2nd of 2008, the WIN company purchased as short-term investment a $1 million face value Keene Company 8% bond for $910,000 plus accrued interest to yield 10%. The bonds mature on January 1st, 2015, pay interest annually on January 1st, and are classified as trading securities. On December 31st, 2008, the bonds had a market value of $945,000. On February 13th, 2009, WIN sold the bonds for $920,000. In its December 31st, 2008 balance sheet, what amount should WIN report for short-term investments in trading debt securities? Okay, basically what happens is, because this is trading, it does not matter whether you elect the fair value option or not. The accounting is exactly the same. If you elect the fair value option or you don't elect the fair value option, the accounting is the same under standard number 115 and standard number 159 for trading. Basically, you put it on your balance sheet at fair market value. The fair market value is $945, and the difference between the purchase price, which was $910,000, and the fair market value is $945, would be an unrealized gain, and that would go to income from continuing operations. And the treatment is exactly the same for the trading category under standard number 115 versus standard number 159. It's exactly the same accounting. So they want to know, in its December 31st, 2008 balance sheet, what amount should WIN report for short-term investments in trading debt securities? The correct answer is reported at fair market value, which is $945. The answer then would be C. Okay, now the next one I want to do is item number 23. Number 23 is right below it on page 364. I want you to read that, and in the next one, I'm going to come back and I'm going to have the solution for you already on the board.